There is an institution in Washington, D.C., that has an emergency phone. When a country's currency collapses, when its bond market seizes up, when its foreign reserves run dry and its government can no longer pay its creditors, that phone is what you call. The institution on the other end will listen. It will assess. It will, in all likelihood, offer help. The help comes with conditions attached. A list of reforms, a set of targets, a program of adjustments that the borrowing country must implement in exchange for access to the funds it desperately needs. The institution calls itself the world's lender of last resort. It calls its programs support. It describes its conditions as ownership, the idea that the borrowing country has genuinely agreed to the reforms, rather than accepting them under duress, in the way that a man with a gun to his head technically agrees to hand over his wallet. Here's the thing about that phone. It exists. It works. Countries have called it and received funds that prevented immediate collapse. That is real and it matters, and the IMF's defenders are right to say it. But here's the other thing. The institution on the other end of that phone is not neutral. Its governance is controlled by design by the wealthiest nations on earth. Its prescriptions have, in multiple documented cases, made the patient sicker. And its own research department, buried in footnotes, published in technical working papers that most journalists never read, has periodically acknowledged this. The IMF has, on more than one occasion, published a formal correction of its own operating assumptions, while the patients who received the treatment based on those assumptions were still paying the cost. That is the dilemma. The doctor is real. The medicine sometimes works. The doctor's salary is paid by the creditors. And the patient doesn't get to choose a different doctor. What the IMF actually is. Let's start with the machinery, because the IMF is genuinely misunderstood, by people who think it is the world's dispassionate economic policeman, and by people who think it is simply a tool of Western imperialism. Both characterizations miss something important. The reality is more structurally interesting than either. The International Monetary Fund was created at the Bretton Woods Conference in 1944, alongside the World Bank, as part of the post-war architecture of international economic governance. The United States had just emerged from the Second World War as the world's dominant economic power. The dollar was pegged to gold. The IMF's job was to manage the fixed exchange rate system, provide short-term financing to countries experiencing balance of payments problems, and prevent the competitive devaluations and beggar-thy-neighbor policies that had contributed to the Great Depression. Footnote 1. The world that created the IMF was a very specific world with very specific problems. That world has not existed since 1971, when Nixon ended dollar-gold convertibility and the Bretton Woods fixed exchange rate system collapsed. The IMF has been adapting its mandate ever since, and the question of what it is actually for has never been fully resolved. As of November 2025, the IMF had 21 active lending programs totaling $115 billion. The three largest, Mexico at $24 billion, Argentina at $20 billion, and Ukraine at $16 billion. Footnote 2. These are not small numbers. They represent real lifelines to countries in genuine distress. The IMF's resources, drawn from member country quota contributions, give it the capacity to intervene at a scale that no bilateral lender can easily match. It is, in the most literal sense, the only institution on earth with the combination of resources, mandate, and global membership to function as a lender of last resort for sovereign governments. Now, the governance. This is where the machinery gets interesting. Every member country contributes to the IMF's resources through a quota, a financial contribution whose size is determined by a formula weighted toward economic output, trade openness, and foreign reserves. Footnote 3. That quota determines two things: how much a country can borrow from the IMF, and how many votes it gets on the executive board. Voting power and financial contribution are the same number. The institution that adjudicates the financial distress of the world's poorest nations is governed by a voting system explicitly designed to give the most votes to the world's richest ones. The United States holds 16.49% of the votes, the single largest share of any member. Major decisions at the IMF require 85% approval. Footnote 2. The arithmetic is simple and the implication is unambiguous. The United States can unilaterally veto major policy decisions. Every managing director in the institution's history has been European, by an informal agreement, the so-called gentleman's agreement, with the World Bank presidency going to an American. The institution that exists to help developing countries in crisis has never once been led by someone from a developing country. China has an actual quota share of 6.39%, while its calculated quota share, what the formula says it should be based on its economic weight, is 13.72%. To bring China's actual share into line with its calculated share would require reducing the U.S. share from 16.49% to 14.94%, below the 15% threshold that preserves the U.S. veto. Footnote 3. This is why the quota reform that the IMF's own Board of Governors described as urgent has been stuck for years. The country that would need to give something up to make the institution more legitimate is the same country with the power to block the change. This is not a conspiracy. It is a governance structure. But a governance structure is a choice. And this one was made in 1944 by people whose interests it served. The prescription: what the IMF actually demands. When a country calls the emergency phone and the IMF answers, what follows is a negotiation. The word, negotiation, is doing significant work in that sentence. The standard IMF program involves a set of conditions, formally called conditionalities, that the borrowing country must implement in exchange for access to funds. Footnote 4. These conditions have evolved over the decades, and the IMF has genuinely reformed aspects of its approach in response to criticism. But the core package, sometimes called the Washington Consensus, has remained recognizable across 70 years of program history. Fiscal austerity, currency devaluation or market-determined exchange rates, interest rate increases, privatization of state assets, trade liberalization and market deregulation. Footnote 5. The theory is coherent. A country in debt distress has, by definition, been spending more than it earns. It needs to close that gap. Austerity closes the gap on the spending side. Devaluation makes exports more competitive, improving the trade balance. Higher interest rates attract foreign capital and defend the currency. Privatization raises revenue. Liberalization improves long-term growth. On paper, assembled in sequence, this is a plausible model for restoring solvency. The empirical record is considerably messier. Argentina has been in an IMF program in one form or another for most of its modern economic history. It has defaulted on its sovereign debt 9 times, the most recent in 2020. The 2018 IMF program, the largest in the institution's history at $57 billion, was followed by a currency collapse, a return to default, and an inflation rate that peaked above 200% in 2023. The IMF's own post-program review acknowledged sequencing errors, insufficient attention to institutional fragility, and social protection gaps. Footnote 6. Argentina is an extreme case. Its economic dysfunction has roots that long predate any IMF involvement. But it is also a country that has been following IMF prescriptions in various forms for decades, and remains among the most economically unstable large countries on Earth. Greece is the European case and the most forensically documented. In 2010, Greece received the first of 3 bailout programs, from the IMF, the European Central Bank and the EU, collectively the Troika. The conditions were severe: deep spending cuts, pension reductions, wage freezes, privatizations. The stated goal was to restore debt sustainability. Between 2010 and 2018, Greece's debt-to-GDP ratio went from approximately 127% to approximately 181%. The economy contracted by 25% over the program period, a depression-level contraction, comparable in scale to the United States during the 1930s. Unemployment peaked at 27%. Footnote 7. The debt was less sustainable at the end of the program than at the beginning. This is not a case where the patient ignored the prescription. Greece implemented the program, largely as required, across 3 successive governments. The prescription did not work. And the institution that prescribed it has partially acknowledged why. The mea culpa, and what it cost. In October 2012, buried in a technical box in the IMF's World Economic Outlook, not a press release, not a headline, a 3-page box in a technical document, the IMF's chief economist Olivier Blanchard and his colleague Daniel Lee published what became known in economic circles as the mea culpa. The finding was this: the IMF had been systematically underestimating the fiscal multiplier, the measure of how much economic output contracts for every unit of government spending cut, since the beginning of the Eurozone crisis. The IMF had assumed multipliers of around 0.5, meaning a $1 cut in government spending would reduce GDP by about 50 cents. The actual multipliers they found were between 0.9 and 1.7. Footnote 8. Meaning that for every dollar cut from government spending in an already contracting economy, GDP fell by between 90 cents and $1.70. Read that again. The IMF had prescribed austerity to distressed economies based on a model that significantly underestimated how damaging austerity would be to those economies. Countries implemented the programs. The economies contracted more than predicted. The debt-to-GDP ratios, the very thing the programs were designed to reduce, worsened because the denominator of that ratio, GDP, was falling faster than the numerator, debt, was being reduced. The mea culpa was published in October 2012. Greece's first program had begun in May 2010. The suffering inflicted in those 2.5 years, the pension cuts, the unemployment, the healthcare deterioration, the emigration wave, was inflicted based on a model that the IMF's own research had now found to be wrong. As one economist observed at the time, if a private researcher publishes a paper saying austerity will not be costly and 2 years later retracts the statement, the impact on the world is zero. If the IMF does the same, during those 2 years huge suffering is needlessly inflicted on masses of people. The IMF has, to its credit, continued to publish research critical of its own prescriptions. A 2016 paper by IMF economists asked whether neoliberal policies had been oversold, and concluded, carefully and with extensive caveats, that in some cases they had. Footnote 9. The fund has increasingly incorporated social protection floors into its program designs and speaks publicly about inclusive growth. These are genuine shifts. But the governance structure that shapes which countries get programs, on what terms, and under whose political pressure, that has not fundamentally changed. The mea culpa was published. The quota reform remains blocked. The gentleman's agreement remains in force. Every managing director is still European. Every door has a locked room behind it. The geopolitical undertow, who the IMF serves and the alternatives forming. Here is where the governance structure and the prescription problem converge into something larger. The IMF's largest borrowers, the countries most dependent on its emergency phone, are overwhelmingly in the global south, sub-Saharan Africa, Latin America, South and Southeast Asia. The global north holds 9 times more voting power at the IMF than the global south, relative to population. The countries that design the programs are not the countries that live inside them. This asymmetry has been visible for decades. But in the current environment, the debt distress environment mapped in Episode 3, the creditor positioning mapped in Episode 4, it is producing something new. Countries in distress are increasingly looking for alternatives to the IMF's emergency phone. And alternatives are forming. China's bilateral lending through its Belt and Road Initiative has, over the past decade, deployed an estimated $1 trillion in infrastructure and development financing across more than 140 countries. Footnote 10. Chinese loans do not come with IMF-style structural adjustment conditions. They come with different conditions. Typically, infrastructure projects built by Chinese firms with Chinese labor, using Chinese financing, and in some cases with collateral arrangements that have raised concerns about debt trap diplomacy. The evidence on whether Chinese lending actually constitutes a debt trap is contested in the academic literature. Footnote 11. What is not contested is that it represents an alternative, a phone that distressed countries can call that is not in Washington. The BRICS New Development Bank, established in 2015, now has 40 member countries and a $100 billion emergency reserve arrangement. It does not yet have the IMF's resources or institutional depth. But its stated mandate is explicitly different, lending without the conditionalities that have defined, and in critics' view distorted, IMF programming for decades. Footnote 12. The IMF is aware of all of this. Its leadership has spoken publicly about the need for reform, for greater representation of emerging markets, for more attention to growth and social protection alongside fiscal adjustment. The June 2025 deadline set by the Board of Governors for quota formula progress came and went without resolution. Footnote 3. The U.S. veto remains. The gentleman's agreement remains. The largest shareholders have the most to lose from a more representative institution, and the most power to prevent one from emerging. The world's emergency phone is answered by an institution that was designed in 1944 to serve the interests of 1944's dominant powers, and whose governance has not kept pace with the shift in economic weight that has occurred in the 80 years since. Countries in distress still call it, because it is the largest and most capable lender of last resort that exists. But more of them are also dialing other numbers. And the institution that was supposed to be above geopolitics is increasingly a terrain on which geopolitics is being fought. The IMF's dilemma is not just about whether the prescription works. It is about whether an institution structurally controlled by creditors can ever fully represent the interests of debtors. The doctor and the patient have different interests. That is not an accusation. It is a governance structure. And governance structures, as this series has argued from the beginning, are choices, made by specific people at specific moments for specific reasons, with consequences that outlast the people who made them. The prescription the IMF carries in its bag, the next episode's subject, is a story of its own. Because the tools that austerity programs depend on have a track record. And the track record says that the cure, applied without modification, in the wrong conditions, to the wrong patient at the wrong moment, can be indistinguishable from the disease. The IMF exists. It has resources. It has prevented sovereign defaults that would have caused real damage to real people. Those things are true and they matter. The IMF is also governed by a structure that gives a veto to one country, reserves its leadership for one continent, and systematically underrepresents the nations most likely to need its help. Its flagship prescription has, in documented cases, made the debt problem it was designed to solve measurably worse. And its own research department has published the evidence for both of those things, carefully, technically, in documents that policy remained largely unchanged in response to. That is not a neutral institution. That is an institution with a structural conflict of interest, a mixed track record, and a governance problem it cannot solve because the people with the power to solve it benefit from leaving it unsolved. Next episode, we are going to look at the prescription itself, the standard package that arrives with every IMF program, and whether cutting spending in a contracting economy is a treatment plan or a different kind of emergency. Because eventually the bill arrives. And sometimes the people handing it out are also the ones who wrote it. So until next time, for another episode in the Economic Reckoning series.